Welcome to LPA Logical Price Action, the complete course, session 3, volume. If you could take a quick read of the disclaimer and the copyright, please don't share on any file sharing websites or torrents, etc. And today's agenda. We will be discussing, as we said, its volume. This is our topic of the day. A whole day is based on volume. What does volume mean? And how do we work volume into our bar analysis? So we start off with a basic volume study, a basic bar by bar study with the integration of volume. And then we get into big studies where we amalgamate bars and volume. Some of these may have 30, 40, 50 bars on the chart. And we have a Euro futures study, a crude oil study, a gold study, and we also have an E-mini S&P study where we amalgamate bars and volume and the inclusion of some structure. Today we up the pace, and this is an intense session. Although it appears we're not covering a great deal, they require the level of concentration we require, and to understand these concepts is deep. It will take some time and effort. Let's do a recap. Last session we covered the basics of bar analysis, the importance of the spread, the close, and the all-important context, which is the barometer. It's by comparing the most recent bar to previous bars that we can determine the length of the spread, the current strength or weakness, whether it's buying of good quality or buying of poor quality. If you remember, without volume, we can see here that the buying quality has decreased. This is just a brief recap. Was there any follow through? It could be the highest close of the previous 5 bars, or have we broken a structural area? Is it a reversal bar, etc. But now we are going to apply volume to our analysis, and this brings our static 2D charts of price bars into the third dimension. It brings the humble chart alive. What do I mean by this? Well, volume is activity. It's measuring the total number of transactions, how many shares or contracts are being traded within an individual price bar for a certain period. Obviously the period being the time frame. A 1 minute chart, for example, shows 1 minute's worth of activity. And a daily chart provides 24 hours of activity per bar. And by the volume, we can gauge a sense of the force behind the buying and selling. Activity, in this sense, represents life. The higher the activity, which is volume, the greater the force of either selling or buying is present in the bar. And this is how we use volume. It's to measure the force of buying or selling in an individual bar. And here today we will learn some of the subtleties of the bar volume relationship. And there is much, there is much more to this analysis than meets the eye. For the majority of traders, the main volume price relationship they have adopted is as follows. For the most part, this table here is correct, but it's just a guideline. Okay, and these are the conditions that we look for whilst we're in a trade to determine whether a position is in good shape. So in the correct context, these rules do apply, hence when we're in a trade. So let's have a look. So when price is up, we're going higher, and volume is increasing, we would say the market is bullish. And if we're making higher prices and volume is decreasing, I say that this would be bearish. Alternatively, if we're coming down and volume is increasing, then price is bearish. And if we're coming down and volume is decreasing, it's getting lower and we're coming down, people say it tends to be bullish. Now these are very vague concepts. Okay, I mean this is general use that I'm sure most of you are familiar with. But we need to make sure that our foundations are correct before we dig deep into the advanced use. Now let's go on to a little study here. This is a basic volume study. It highlights the basic use of volume. I say basic, but most traders still don't use this correctly. Or should I say, they don't extract the amount of data or the importance from the chart. For example, we come down to A and volume increases. So we would say that's good. Let's just use a positive. That's good quality selling. As we rally higher, volume decreases. So we'd say that's negative. So poor buying. We react from B to C. What do we notice? Volume increases. So this is positive. This is negative. React from B to C. That's positive. Then C to D. Again, volume decreases. So it's negative. Then D to E. What do we notice here? Well, volume is sustained. But what do we notice? There's ease of movement. We push the market down with sustained volume. So that is positive. Now here, it gets interesting. E to F. We have a little resistance level. We draw this in. We try to break into new highs with very low volume. E to F, volume declines. Where has demand gone? And then when we react from F to G, volume increases. Sellers are active. And then when we come back to resistance from G to H, where is the volume? That is very negative. So the buying pressure is non-existent. It's the lowest volume we have on the chart. So we get easy trades here and here. And this happens frequently, especially in an intraday environment. Look what happens when we react. Volume increases. Good quality selling. And using structure, we draw in support. Boom. It hits perfectly. So we're not surprised that we get this bar. And this is how we use basic structure and volume in our studies. Think about this. This is very basic, yet extremely useful. We don't need any other price bar info. We can see from this one day on the Nasdaq, this is Nasdaq futures on a 5-minute chart. So from this one day, by reading the 5-minute chart, by putting in resistance, and we try to break here with decrease in volume, there's very low volume. We already know from our previous studies of structure that we want to see a good wide spread to break, agreed? Which validates the level. Does this look like a good wide spread? No, it doesn't. But now we have the inclusion of volume. So volume also confirms weakness. And then we try to break here with the lowest volume on the chart. We have easy trades here and here. They're no-brainers. And we can also compare the buying. Look at the buying from B to C, from A to B declines. C to D declines. E to F declines. Then H, non-existent. And where are we? At resistance. So demand pressure is decreasing and we're at resistance, whilst we've noticed that there's good quality selling. Every time the sellers have an opportunity to sell, volume's increasing. Okay, can you see how this works? It's phenomenal. It's phenomenal how this works, and it does work on time to time. However, there are many nuances to the price volume relationship that cannot be categorized into this table. It's not so black and white. We can't pigeonhole volume into this chart. Well, not for our methodology. We are the experts. We are the leading authority in the world for the price bar volume relationship. There is no other form of trading that comes close to our understanding of the bar volume relationship. This is our field of expertise. This is the number one methodology of using bar and volume in the world, bar none. Therefore, this simple table, although useful in its own right, does not contain all the data. It's very bland. This will come apparent to you as we go into the bar volume relationship into depth. Okay. I mean, for example, like climatic bars is when we have big, wide spreads that have huge volume that close off the highs. Is actually, you may think that is bullish, but it's actually far from bullish. It's one of the weakest bars we have. And previously, we have narrow spreads rising on low volume, like we spoke about last session. That's bullish, as we know. Why? Because supply has been eradicated either from absorption, a shakeout bar, or accumulation. So this indicates there is no supply in the market. But if we use this table, so price is up and volume is decreasing or very low, it's bearish. No, it's not. It's actually bullish. You see, this is why we cannot be mechanical within this methodology. We always have to use our discretion. And obviously this is contextual. We need to have the right background conditions for this to be behavior. We need to see that we come from absorption or a shout here before or accumulation. Therefore, be aware that the table does not disclose the full picture and has limitations and must only be used as a rough guide. If a trader were only to use this table for volume analysis alone, it's very probable that they will encounter a short lifespan in the markets. Of course, this table worked in a sense for this study here, and that's fine, that's okay. How I like to think about this kind of volume analysis is it's a mere tool, and on this day our tool worked. And when we see this occur, when we see that the volume is in sync with the price action like this, and this is textbook, by the way, this is perfect. When we can see this, we can use it to our advantage and we have trades. But we know that the markets are far from perfect and can be very ambiguous. This is merely one of our tools within our toolbox, and we need to know when to use our tools. Okay, so when we can see that the volume price relationship is in sync like this, then we can look for trades at structure. Good. Without further ado, let's begin our study into the secret language of bars and volume. So here we have a bar by bar study. When we begin to use the bar volume relationship, we don't necessarily examine every single bar on the chart. We look for bars of interest or mere continuation of trend. Like bars of interest would be widespread bars, high volume bars, a mixture of both, and bars at structural locations. Bars at structure, these are monitored very closely. And for continuation of trend, we look for buying of good quality if bullish, with selling of poor quality. And if bearish, we look for selling of good quality and buying of poor quality. We use the same analysis that we have previously learned in session 2, but now with the addition of volume, which of course is the fuel, the activity. It's the force behind the selling or buying. Now if we look to the chart, what do we note about bar A? Well, there's no other bars on the chart, so we'd have to say it has an average spread with average volume. So down here, this is volume. Blue bars of volume. So we'd note that bar A has an average spread, average volume, and a weak close because it closes bang on the lows. So don't forget, we have no context. This is all we have. But safely, we could say that sellers are in control because there's no other information on the bar. What do we note about bar B? Well, it has a smaller spread, volume declines, and it also closes weak on its lows, and it makes a lower low. So we can see that the thrust has shortened. Now, this is the important part. Although volume has decreased, the spread-volume relationship is intact. It's in sync. We have a wider spread, but we have higher volume. Here we have a smaller spread, and the volume has decreased. It's in sync. Although the thrust has shortened, sellers are still in control. I'll say that again. We have a spread with good volume, and then the spread decreases, but so does the volume. So therefore we'd say the spread volume relationship is in sync. It's intact. So C. What do we note about C? Well, we'd probably say it's an average spread, but has high volume. It's higher than A and B, and it closes off the lows. So this indicates that potential buying has entered the market. And we know that because a close off the lows indicates buying. But we also have higher volume. Now think about this. With over twice the amount of volume than B, and a good 40% more volume than A, the spread is actually smaller than A and only a little bigger than B. So all this volume, which is activity, was genuine selling, we would have a spread that comes down and closes like this. Therefore, we know buying must have occurred. In addition, we close off the lows, which indicates a little buying. Don't forget, we have still made a lower low, and we are in a downtrend with increasing volume. That's why we use the word potential buying. We need confirmation. This could be mere profit taking. What do I mean? Well, I know it's hypothetical, but this could be support. People short from here note this is support and they take some profits. Okay, so it could be potential profit taking. People liquidating the short positions. We just don't know as yet. So just for a recap, we have potential buying that has entered the market, and we know that due to the close off the lows, and we have twice the volume as B, 40% more volume than A, yet the spread is smaller. All that extra activity, which is volume, must be buying. Now we come to D. What do we note about D? Well, it has a smaller spread than C with higher volume. That closes mid-bar. So we have higher volume with no downside progress. Think logically. Just think deep about this action. With the highest volume, or activity on the chart, we are unable to make any downside progress in a downtrend. In fact, we dip under the lows to reverse and close mid-bar. For all intents and purposes, we'll say that the closes are in line, but it is slightly higher. If we combine bar D with bar C, a story of potential demand is entering the market. However, we still need confirmation. We are in a downtrend. If we combine D with C, we have a story of potential demand entering the market. However, we still need confirmation. This doesn't mean we go long here. We are in a downtrend. But potential demand at C, and then D, the next bar with higher volume, we hold. And there's no continuation to the downside. And look how far we retrace into the previous bar. A good 75%. This tells us that demand is in the market. Not only does it dip under to reverse and close above this close with increasing volume and a smaller spread, we're kind of, we're halting here and we're retracing deep into the previous bar. Only buying can do that. Only buying can do that. And if I'm short from up here for whatever reason, I'd be concerned. I would tighten my stop to either one of these highs. The market's hinting towards some sort of strength of one form or another. Again, it doesn't mean we long here, but something's occurring. Selling is not having an effect as it did here and here. What do we note about bar E? Well, a slightly smaller than average spread if we compare it to B and D, but it does have low volume and it closes firm above the previous two closes, where we actually have a cluster of closes, and we know this to be bullish. This is telling us that price is unwilling to go lower. Buyers are stepping in and holding this level, and we trace deep into the previous bar. Think deep about this action from bar E. We have low volume and we dip under these lows, find no further selling to reverse and close firm in a cluster above the previous two closes. This tells us that the selling force has decreased, especially when we combine it with bars C, potential buying, and D, where we've noted buying. Interesting, huh? What do we note about bar F? High volume, very wide spread. And from our previous price action, what does the bar achieve? Now this bar achieves a great deal. We rally past and close above 1, 2, 3 highs. We close above 1, 2, 3, 4, 5 closes. And we close above 2 lows. With no downside continuation. So buyers, we could say, are in full control. Buyers have control. And if we note the volume spread relationship, what can we say? The spread volume relationship is intact. If we compare to the previous bar E, which is an up bar, the spread is 2.5 times the size and the volume is 3 times the size. So that's fine. We are in sync. Now think about this. F accomplishes a great deal, and we have all this force, all this volume, and we are rewarded as we break above these highs, these closes and these lows. Very important. This is the way we like to think. What does this good demand, this is good quality buying, what does it achieve? And it achieves a great deal. So therefore, it is buying of good quality. Bar G, what do we note? Narrow spread, low volume. In fact, the lowest volume on the chart. So this we would call poor selling. And although it's negative, it's actually bullish behavior. Why? Because of context. We have demand directly behind us. With good volume, good widespread, that accomplishes a great deal. Then bar H, narrow spread, narrower still on even lower volume, closing weak on its lows. So technically, yes, this is a down bar. This bar is extremely bullish. The force of selling, the activity on this bar is very weak. There's no ability for lower prices. If we combine this with G and H, we can see there's no selling pressure. Where's the selling we saw here and here and here? There isn't any. And our immediate background is strength. Think about this. We have potential buying followed by buying. Then we get no indications of supply, good demand, and then no supply. Comfortable long play, right? We don't need structure here. This is telling us there's no supply in the market. J. What do we note about bar J? It's an average spread, closes firm with average volume. However, the volume is more than twice the amount of G. And there is no downside follow through. So the force of buying is average. Yet we get good flow. We get good ease of movement. We push up. This indicates there is a lack of supply in the market. Buyers are in full control on this bar. Think deep about bar J. The spread is 3 times the size of G and H, yet the volume is only double. What does this mean? It means there's a lack of selling. There's no selling friction as we drive up. So the average volume manages to push the market with ease. Does this make sense? Yes, of course. Why? Because both of these bars here tell us there's no supply in the market, and this bar here confirms there's no supply in the market. How? By driving up higher with average volume. We get a good spread with average volume, and that's bullish. So this tells us that buyers are in control. Look, think of it like this. Down here, supply overcomes demand. Here we have a turning point, so it's neutral. Yes, we should be coming down, but all this volume and we hold. Don't forget we're in a downtrend, so it is neutral. We don't go anywhere, but then we drive up where where demand overcomes supply on this bar. Then we get confirmation there's no supply from G and H, and this is the result of all this action. We're able to push the market up. We're able to drive the market into new highs with average volume. It's fascinating. It truly is amazing how we can depict the forces, the strength of buying and selling when we incorporate volume, which is the force. It's the force behind the movement of the bar. Okay, and when we combine the spread and the volume and the close, we can obtain an astronomical amount of data. So, are there any questions on this chart? If bar E closed higher with the same volume, would it still show no supply? If bar E... Okay, so it's a hypothetical question. I'll answer it. So, if we close here, would this still show no supply? Yes. In fact, I would prefer it. Why? Well, on C, we've noted there was potential buying. At that moment, it's only potential. We don't know, but we note the volume and the close off the lows. Potential buying. Bar D, we noted with higher volume and a smaller spread that we know that buying must have occurred. Has to be. Then we dip under and reverse, breaking these closes, breaking this high to reverse and close firm. It would mean we have this bar, J, at E. Why? Well, it would tell me that bars C and D, with this high volume, level closes, have eradicated supply. Because we dip under and reverse to close firm. Think about it. We're coming down. We're coming down here. Then we hold with all this volume. We don't go anywhere. Then we dip under. So at bar E, as we're under all this price action here, sellers have an opportunity to pull the market down because we're in a downtrend. And we've got good volume here. So why are we not continuing south? It's a question mark. But not only that, we reverse to close firm above this high with low volume. So this tells me there's no selling friction. There's no selling in the market. And we'd have to presume at D and C with a high volume, making no progress, halting, clustered closes here, has eradicated supply. So why aren't we continuing south? It's because no one wants to sell. It's simple as that. And due to the low volume and the ease of moving up, we know that for a fact. It doesn't mean we buy this bar. We're just building a story of strength to give us a license for a long play, which we get at F. This tells us demand is in the market after this turning point. Then we see this. When you're an apt chart reader, we can buy the no supply bars. And obviously this is the result of all this conditioning. Excellent question. Okay, it does answer it. No, it is not a no demand bar. A no demand bar, oh, I see where you're going. No, a no demand bar is when we're in a downtrend and then you get a very small narrow bar with very low volume. That should be higher than the previous two closes. We study these in detail, don't worry. But here we dip under and reverse to close firm. And we have more or less an average spread, or slightly smaller than average spread. We do get low volume, but not very low. We want low volume like H for no demand bar, an extremely narrow bar like this. I understand your thought process, but it is not a no demand bar. We will discuss no demand bars in length. Okay. Where would I enter on the chart? Well, C, no, potential buying. D, we know buying exists. E, it indicates no sellers. F, this shows there's good demand, but we still want to wait for a weak pullback. And we get that here. So personally, I would enter on the close via H. I mean, how you enter from H is discretionary. Of course, there are many ways. You can, I like to buy the closes on no supply bars. But you could wait until we break this high, or high 2 bars back, or we can note that this is a level. And as we break up, as we push up, we can let the market pull us in with a buy stop. But that's up to you. Alternatively, a conservative way is, although this is no supply and we can have a good story, perhaps you want further confirmation and you want to see good demand like this after no supply. So then you wait for a weak pullback wherever that may come. But don't forget, you always pay for confirmation. If this is your confirmation bar, where do you put your stop? It's very difficult. Under here, but really the best place, the catastrophic stop, is always under the previous swing low. It's here. But with no supply bars, we get instant gratification. If we start coming down, you know your analysis is wrong. Okay, then you exit. It appears there are no further questions. Let's go on to the next.